Here's your Washington, D.C. Metro April market update. So, the big story we've been tracking all year is inventory. There's just not enough of it. Now, we've been saying that for years, but you can actually see here it's worse now than it was in previous years. New listings coming on are actually flat, inventory staying flat when we typically see a big increase now during the spring months. We actually do have a supply chain issue. We do expect Q4 to be low on new listings. Q1 starts to tick up a little bit, but when you look at the last 6 months here, and I've highlighted Q4 and Q1 for the previous 7 years, you can see we're way down. In fact, looking at the 10-year or the 7-year average, we're down 26% compared to what we usually see in Q4 and Q1. How bad are we compared to the rest of the country? Well, overall, on average, the US is up 23% on their inventory in March. We're actually down a ton. You can see we actually are one of the worst for having new inventory come on the market. So we need new sellers for people to buy. I saw this headline, and I always like to do the predictions at the beginning of the year, but it's interesting to see some of these research firms are now revising their forecast after they've seen what's happened over the first few months, which is understandable. So looking at really where they've come, what's interesting about this is almost all of them, except for Fannie Mae, think that prices will actually fare better in 2023 than what they thought when the year first started. So even somebody like KPMG, one of the big four accounting firms that still says prices will be down nationally 8%, they actually said that it was going to be down 15% just a couple months ago. So they're already revising those and seeing that prices are going to hold a little bit more steady because of the lack of listings. Here's what some of these firms are saying nationally. West Coast, bad. East Coast, much better. And the reasons why. You can see here through February. So the first couple months of the year, here's what's been going on with the different markets. East Coast good, West Coast is losing value. And then this is just month over month, so you can see it's continuing to trend that way, not by big chunks really, but the gap is widening. This was interesting to see because March was actually the first month that prices went down year over year. Now, it's okay. I don't actually put too much into this. The last time that they went down was December, but then before that, it was May of 2019. So they've been constantly going up year over year by every month. Q1 here is still going to be a total of a cumulative positive of 0.3%. And why do I think this number is going to reverse over the next couple months? Just historically, these next couple months are when prices typically do start shooting up. So this pressure pushing up is going to be hard for that to keep going down. I think we're going to still stick with somewhat stable prices throughout the year, but we'll see a couple more months of probably some modest peaks. And if you look at this graph, think of it as two graphs. It's a red and a blue. When you see the blue, that's month over month, all these markets in the United States are gaining in price appreciation. You can see we just had that little blip where a lot of them started losing, but it's already starting to go back up. It's not going to be anything like what we saw in 2008, but I think this will be a shorter one, and we're probably past the worst of it now based on all signs I'm seeing. Looking here, there's still a seasonal buyer demand here in the spring. You can see through February, and I believe this number is even higher now. March stats are not out for this specific stat. Almost half the homes are going off the market within 2 weeks. There's definitely demand there. Spring season is here. There's definitely less buyers than before, but there's so less listings that percentage-wise, it's kind of equaling out to be a steady spring. And then good news, Q2 almost always, except for 2020, brings a big flurry of new listings to the market. Is it going to happen this year to the extent it has before? Probably not. But do we expect Q2 to be the largest of the quarters this year? Probably. And maybe with all these other external factors, we see Q3 also bring a big chunk this year too, which would mean an elongated spring season, which I think would be good for everybody. And mortgage rates are still projected to go down. So if we're through the highest part already, that's great. By the end of the year, you can see some people are expecting below 5.5. I believe once we get to 5.5, we'll see a lot of people comfortable with selling their homes. And really my summary of what I'm seeing in the market is this. Buyers are comfortable purchasing a home at 6% now. They're coming to terms with it. But who's not comfortable is sellers trading in their 3% for a 6%. I believe once we get under that 5.5 mark, we're going to start to see a lot more sellers who have been living in cramped spaces and wanted to move over the past year but have been delaying are going to start putting their homes to the market. Let's hope that those trickle out, because too much too soon can actually hurt prices. And then you can see the mortgage demand is continuing to go up. As of last week, we typically see a jump from February to March of about 30%. This year, from February to March, the buyers are coming out a little bit later. Although there's not enough homes for them to buy, you saw a 43% spike in people getting their rate lock. And then just yesterday, new data came out for the economy, and we got the notes from the Fed. It's very likely, although this isn't guaranteed, that the Fed is going to raise rates another 0.25%, but that will be the last one they do. Another signal that we're past the worst of things for this, and rates will start to trend downwards again, which means good things for our housing market, because sellers will decide to trade in those ultra low interest rates for still good rates, but just not these amazing 3% and sub 3% rates, which were once in a lifetime type things. And we're seeing a lot of market normalization. So I'm optimistic about the future. Hope this is helpful.